Welcome to the second module in the Investing for Women Getting Started education program. In this module, we will start to review some things you need to know and understand before you begin investing. Some of it will continue into module number 3 as there's much to cover. So let's get started. The first thing you will want to do is get a better understanding of yourself. Think of things like your spending habits or your saving habits. When your paycheck comes in, are you spending it the right way? Are you spending it on things you want and do not need? Or are you spending it on paying bills? Are you saving anything at all, and where is it being saved? And how about your risk tolerance? Is money a sensitive topic for you? Do you feel anxiety at the topic of investing? Or are you comfortable with investing and just need to learn a bit more? And if you are going to get started with investing, do you have the time to set aside and learn? Are you able to manage and keep track of your financial plan? Or perhaps if you have made the amazing move in working with a professional, are you taking time out to meet and discuss with your advisor? Really know yourself and understand your habits. Share it with a professional where applicable and put a strategy in place to move forward. And before you do any investing, it's always important to know what your goals are and what you are investing for. In previous education modules for her program, we have often discussed how goal setting is so important, and really it's the first step and it's no different here. Your investment portfolio will look comparably different when it's meant for retirement versus a portfolio that's meant to help with your children's education. Determine your goals. Outline the timeline as to when you need to meet these goals. These are your first steps. And remember, do not forget about the life events we have discussed in previous modules. If any of them are upcoming or may come due to unforeseen circumstances, you want to be prepared. As a reminder, some of those life events include getting a job or starting a business, getting married, buying your first home or perhaps a new home, growing your family, your children's education, your children's marriage, vacation, buying an investment property, retirement, death, both yourself or a loved one. Disability, critical illness such as cancer, heart disease, and so forth. Loss of a job, natural disasters such as earthquakes, floods, divorce or separation, supporting elderly parents. The word risk refers to the probability that you may lose money on an investment you made. Usually, an investment is the purchase of an asset for the sole purpose of earning money through income, which can be interest and dividends, and or capital appreciation, which can be selling asset for a profit. For example, you buy shares of stock in a company with the hope that the value of the stock will rise. If the stock rises, you earn a profit. That is the reward. You purchased a share for ₹100 and is now selling at ₹120. Your profit on this share is ₹20 a share. There's no guarantee, however, that the company will surely make money and the value of the stock will rise. There are chances that the value of the share can dip to ₹90 per share and you will incur a loss. Now, key thing to remember, in the case where the share fell to ₹90, it's loss as soon as you sell. If you haven't sold yet and are still holding it, then you say the value of your share is down. Same thing goes with profit. In the example I mentioned, the value of your shares is up by 20, but the moment you sell, then your profit is 20 per share. The risk-reward ratio denotes a prospective amount of reward you, as an investor, can earn for every rupee you risk while investing. You can use the risk-reward ratios for comparison of expected returns on investment with the amount of risk you undertake to earn these returns. For example, you have a prospect of investment with a risk-reward ratio of 1:8. It means that you are willing to risk ₹1 for the prospect of earning ₹8. Alternatively, a risk-reward ratio of 1:3 signals that you should expect to invest ₹1 for the prospect of earning ₹3 on this investment. The risk-reward ratio is used to understand the capital and risk of loss. The ratio helps in the assessment of the expected return and risk of a given trade. Remember, as a rule of thumb, the higher the risk, the higher the reward. But the key here is to understand yourself, your nature, and thus your capacity to take a certain level of risk. Now there's a huge misconception out there where people feel you need a lot of money to start investing. Though it's great to have a lump sum of money to invest, when that's not possible, then consider automating your savings into investments at regular intervals. For many, this is the best way to get into a habit of savings and to begin investing. And it has advantages too. Have a look at this chart. This chart is showing the advantage of investing a sum of money at a regular interval. In this case, on a monthly basis. The form of savings is also referred to as rupee cost averaging. Essentially, in this scenario, you are investing 200 rupees every month into an investment, say the 15th of every month. Now, as you know, the market goes up and down, meaning on the 15th of every month, you are getting a different cost for that investment. See, in January, you invested 200 rupees at 40 rupees a share. That resulted in you buying 5 shares of that stock. In April, you invested the same amount, but the cost per share has gone down to 18 rupees a share. So you get 11.11 shares that month. And then the following month, the stock has a huge rally and your 200 rupees at 42 rupees per share got you 4.76 shares. So you are asking now, what's the benefit? The benefit really is that your cost for the shares, when you are regularly buying shares of a company at varying prices, the cost of those shares become an average. In this case, in May, the current cost of one share is 42 rupees. Over 5 months, you have accumulated 37.53 shares, and because you bought at those intervals, your cost per share has averaged down to 26.64 rupees. Meaning, if you were to sell all 37.53 shares today at the price of 42 rupees, your total value is 1,576.26 rupees. So you can see you made a profit of 576.26 rupees, and that's because you averaged your cost down per share by buying at the highs and lows. Timing the market just isn't possible, but you sure do get to take advantage of the ups and downs when you invest in this manner. All to say, you don't need a lot of money to start. You just need to start and automate where you can. A common confusion among those new to investing is the difference between diversification and asset allocation. Asset allocation refers to the percentage of stocks, bonds, and cash in your portfolio, including other alternative asset classes, which can be real estate, commodities. Diversification, however, refers to the spread of the money within each asset class. For example, in your stocks asset class, instead of concentrating all your money into a single company, industry, sector, or geography, you should diversify your investments across a range of different companies, industries, and geographies. When you divide your funds across companies, large and small, at home and abroad, in both stocks and bonds, you have fewer chances of losing all of your money during markets' ups and downs. Diversification aims to maximize your returns through investment in different areas that tend to react differently to the same event. According to investment professionals, it does not guarantee against loss, but diversification is the most important strategy of reaching long-range financial goals while minimizing risk. In order to understand where to invest your money, it's important you understand the different types of investments available and the types of returns you can expect from them. Generally speaking, there are 3 main types of investment asset classes you can invest in. First, let's look at equities or stocks. These are shares of ownership issued by publicly traded companies. They are traded on stock exchanges. You can potentially profit from owning equities either through a rise in the share price or by receiving dividends. Equities are considered higher risk investments as share prices can change dramatically over time and there may be risk of losing your money. The second is bonds or fixed income investments. These investments pay investors a rate of return in the form of fixed interest payments until the investment's maturity date. At maturity, investors are repaid the principal amount they have invested. Government and corporate bonds are the most common types of fixed income products and are generally considered less risky than investing in equities or other asset classes. And the third is cash or cash equivalents. These are highly secured financial assets that are liquid, meaning they can be readily converted into cash, such as high-interest saving accounts, short-term guaranteed investment certificates, and other debt instruments with less than a year to maturity. There are also investment vehicles that provide you with an opportunity to own a basket of these investments and can potentially provide you with access to a wider array of investment holdings. For example, a mutual fund. A mutual fund is an investment security that enables people to pool their money together into one professionally managed investment. Essentially, a mutual fund is a pool of money managed by a professional or group of professionals. Ongoing research is conducted by the financial professionals and their team on several companies to determine whether they are good investments to add to the fund. The fund manager then picks the stocks or bonds of selected suitable companies and puts them into a fund. Mutual funds can invest in stocks, bonds, cash, or combination of those assets. The underlying security type, called holdings, combine to form one mutual fund, also called a portfolio. It is important to note that you do not own the actual underlying securities. You own units or shares of the mutual funds, but still participate in the growth or loss of the holdings collectively. Owning mutual funds offers you several advantages, such as making it simple for you and letting professionals do the research. You own a variety of investments through the fund, thereby reducing your risk, and there are normally low minimum investments required, making it accessible to almost everyone. And then there are ETFs. An ETF is a type of investment security that tracks an underlying benchmark index, such as the National Stock Exchange. ETFs are baskets of securities that have multiple stocks, bonds, and other assets, or sometimes even just one asset like gold. ETFs are similar to mutual funds in that you do not own the underlying stock. However, unlike mutual funds, ETFs trade like stocks, meaning that you buy and sell shares of an ETF on an exchange similar to a stock. Both mutual funds and ETFs can be either actively or passively managed, which can affect the rate of return you receive. With actively managed funds, the portfolio manager will often buy and sell the holdings in an attempt to get a better return than a specific benchmark. With a passively managed fund, the portfolio manager will only buy and sell holdings to match the benchmark it tracks to. This may look like a limited option for a beginner investor, but realistically, this is the vast majority of it. As you learn, take advantage of mutual funds and the education and learning you can get from product distributors and advisors. Now it's time for a short quiz, and the first question is, asset allocation is the percentage of dash and dash in your portfolio, and the options are A. Bitcoin, corn, cash, B. Movies, soda, stocks, C. Stocks, bonds and cash, and D. Bonds, cash, silver. Let's move to the second question, and it's true or false. If your investment value rises, you sell and earn a profit. This is your risk. Option A is true, option B is false. The third question is again true or false. Rupee cost averaging is meant for investors with a large sum of money for a one-time investment. Your options are A, true, B, false.